Anand Shanbhag, Head of Research at Tata Capital, now joins us right in our studios. Anand, hi, good morning. Good to have you on the show. Just reading your report about the real interest rates peaking and actually in turn reviving the IIP from here on. If you would elaborate on that.
Yeah, thanks for having Tata Capital on the show. And we would really like to look at this story as something that we call internally as a 3 I's. And our view is that inflation, interest rates and industrial production are now getting interlinked in a way which could, first of all, present a few surprises, positives for the market at large and investors. And we believe that despite the very well-founded concerns about the capital cycle, not capital growth cycle, not being up to the mark, a cut in rates, if it does happen, could actually revive IIP, and that's the thing that I wanted to focus on.
But are you, there was a lot of expectation of a rate cut on December 2nd, but Mr. H.R. Khan, the Deputy Governor, clearly put the RBI's mind on display when he said that the markets are being ahead of the curve or way too happy too early about inflation. So if the cut doesn't come, say, in December and in February and gets postponed to, say, April, are you going to see a major hiccup for the markets at all?
I think the RBI has quite rightly warned, particularly bond investors, that they may be running a bit ahead of the curve, and I think it's good to take that warning on record. But if you look at our hypothesis, we believe that, okay, you have one date which is the 2nd of December, but you also have dates in between the regular policy announcements which would of course be linked to the inflation data that is coming out. And I think there seems to be a lot of hope with caution. So our call is that the hope has very good reasons to be out there, and if not in December, if not in the beginning of December, we wouldn't rule out the possibility that you could actually see a cut even later in the year, by which I mean later in the calendar year. And we believe there's a very good chance of seeing a rate cut because there will be new data that RBI will review, and our call is that if you wait for maybe the end of the fiscal year, there is a better than 50% probability that you might actually see a cut beginning to happen.
Okay, in that case, how does that influence your stock selection?
Okay.
Predicating on a rate cut maybe in the first quarter of next year, if not this year itself?
So the way, Lata, we are looking at it is, we are trying to see which part of the IIP basket is really most sensitive to rates. And we found something very interesting. Our Tata Capital study internally found out that if you look at the IIP and just split it into two parts, one of which is the consumer durables bit, which is roughly 9%, and the other one is a non-durables, which means it includes capital goods, basic goods and everything else, more than 90%. The weakness is almost entirely concentrated in the consumer durables piece for almost the past 6 or 8 quarters. And more interestingly, if you look at the non-durables piece, which is roughly 91% of the IIP, you can actually notice that there has been a distinct upturn, not very strong, but if you compare the overall IIP, which is languishing at about 0.5% to 1%, you can notice a significant upward gap between that and the non-durables part, which is, as I said, about 3.5% to 4%. So our story actually is that we again went back and observed what is it that made the durables piece, behave so badly. And as we all know, it's in such a poor shape with about minus 15% growth for the last quarter or so. And we notice a distinct correlation between the turning point on when the consumer durables part of the bigger basket started to move down, and that completely coincides with the turning point in interest rates.
Okay.
So our call is, coming to your question, that if you were to indeed see, let's say, another turn in the rate cycle, and we believe it's likely, but we'll have to wait and RBI will decide. But if it does happen anytime in the next month to a quarter, the piece that will clearly be most directly and immediately influenced will of course be the consumer durables piece.
Okay.
Now what's there in that? It's really automobiles, it's household goods, it's auto ancillaries. So it is these parts of the economy that we expect will really begin to see that upturn before everything else.
Actually, I was coming to that only then. Autos in particular, so what do you like the most from that space? Because there's a variety of stocks and they've done well, to be fair, one of the leading sectors also this year.
I think, Anuj, the basket is pretty wide within that, but I would also strike a note of caution because when we are talking to investors, we face this question, and our advice has been that at the initial phase of the upturn point in the cycle, it may be a better strategy to play this story through the indirect exposures. And our indirect exposures that we have identified are actually those parts of the listed space that have an exposure. So for instance, the biggest indirect exposure, or the largest one, is actually the financial sector. Let me just step back for half a second. If you look at what is in the consumer durable space, there are a lot of businesses which probably are not represented in the listed market at all. How do you play them? I mean, you really don't have a very good option of getting into those stocks, making an investment. The one thing you could do is that all of those businesses do need capital. They need debt capital, working capital finance, and clearly the listed banks and non-banks which are around all of us are the ones which have an exposure. And please bear in mind, Anuj, that one very important part of this is the SME piece. So we believe that the SMEs which are in the supply chain of the auto manufacturers, the best way to play them is probably to have an exposure to one of the banking or the non-banking stocks.
So which of them?
Okay.
Yesterday we had actually Capital First telling us that he's a big lender to the MSME space. So anyway, what do you like in that space?
So I think the way past cycles have behaved is that when there is a turning point, you really see everybody getting onto the bandwagon. There is going to be nobody left out, but there are individual differences. Somebody will gain more, somebody will gain less. Now that we are at, let us say, a 28,000 Sensex, and where we are on the Nifty, we would believe that getting directly into the smaller cap names may not be the best strategy, and therefore we would advise that you should get into the index names, particularly within the public sector banks. So a favorite, very well established State Bank of India is something that we do like. We also like LIC Housing. We also like Shriram Transport Finance. But when I say this, I would also like to add that there are probably 10 times as many number of stocks either in the respective indices or in the listed space which are not represented. So we are just saying that given the point you referred to, we are at the very initial stage. It is uncertain. Will it happen? Will it not happen? If the hopes are raised and you see a kind of a spring back, then we would believe that staying with the large cap names in the next 1 to 3 months is probably the safer strategy.
Okay. What about capital goods or L&T in particular?
Okay. So if you look at capital goods, it's not at all in as bad a shape as is the, let's say, the consumer durables part of the IIP. And it has clearly seen its valuation move up in anticipation of a whole lot of things. So we look at those names as probably the second leg kind of thing. So one question a lot of investors have been posing to us is how much of a cut do you expect when it begins? I think it really doesn't matter whether it's 0.5% or 0.25%. But once we get full conviction that rates are indeed going to be cut, I think that's the time when I would advise that one should then begin to add to the exposure on the capital goods stocks.
Okay. A lot of noise was made about the oil and gas stocks as soon as the new government was sworn in. Is the party over?
I believe not, and I'm sure we have to all wait for a number of the final details to be kind of spelt out. But please remember one thing: if you are looking at the oil marketing companies in particular, we've just about seen probably 3 quarters of a respectable or a normal valuation after about maybe 16 quarters of a very deeply depressed kind of a zone. So as time goes by, I think investors will gain more confidence in the earnings that these companies will report, and the valuations may then present an even larger upside compared with what you've seen in the past 2 quarters.
Okay. In the mid-cap basket, is there anything that you like?
Anuj, we haven't really put a unique set of names on that, because as I said, mid-caps at this stage in the valuation cycle and at that turning point in the interest rate cycle, it's something that you have to be a bit cautious. And if you have the hopes getting reflected in the prices of mid-caps and the cut does not happen, for instance, let's say till March or April, then you are probably not in a very safe spot in the market. So we would advise that you do keep an eye on mid-caps, but that's again like the large capital goods names, probably the second stage of the investment basket.
Would you invest in any of the real estate companies? When life gets good, people buy a home.
Yes, I think we all would like to buy a home, and life is probably promising to get much better for a whole lot of us. But I think the one good thing about real estate is that if interest rates do move down, you would, of course, see that part of the equation changing in favor of the buyer. But the bigger reason why somebody times his purchase now or next year is not to do with interest rates, it's to do with prices and affordability. And therefore, if you are looking at aggregate demand coming from the genuine buyers, I think it is probably a few quarters away. And we would, unless one wants to take a view on a 4 to 8 quarter horizon, one should probably stay a bit cautious on those names.
Okay. Well, finally, I wanted to ask you about the infrastructure names. There is this expectation the government is going to push infrastructure. There are some of them with fairly decent balance sheets, like maybe an NCC or an IRB. And then there are the bigger ones as well, the GMRs and what have you. You like anything at all in that space?
We like infrastructure in general. We would wait and watch for 2 or 3 specific steps which we believe this government is committed to implement. One of them, as we all know, is getting this coal policy finally implemented and removing whatever lingering doubts are there in the minds of people. And secondly, it is the budget deficit, because if you really observe very closely, even in the most recent week, we've seen a little bit of additional cutbacks in government expenditure. And the ultimate revenue stream of a whole lot of these infrastructure companies, it depends on the government getting back its ability to spend. And there may be a few taxation proposals that may come along to make that happen. So when you look at the total picture, there'll be some good news and something along with it which you may not quite like.
Okay, so not immediately. Anand Shanbhag, you want to ask something else?
Yeah.
Thank you very much, Anand Shanbhag, for joining us.
Thank you, and thanks for having Tata Capital Securities on your call.